Who is the greatest investor of all time? Outside of Wall Street, that answer would seem incredibly obvious. The Oracle of Omaha, Warren Buffett, a name that has been associated with multi-billion-dollar investments longer than most of us have been alive. But you would be wrong, because for those within Wall Street, for those intimately familiar with the ruthless world of finance, it is this man.
I did a lot of math, I made a lot of money, and I gave almost all of it away. That's the story of my life.
Jim Simons, a mathematician who went from lecturing in the hollowed walls of M.I.T. to cracking highly sensitive, encrypted Soviet codes, to building a multi-billion-dollar hedge fund named Renaissance Technologies. Jim Simons conquered math, then used math to conquer foreign governments, and when he was done, he shifted all of his focus to conquer Wall Street. Since 1988, Simons' hedge fund has achieved an almost unbelievable annual return of 66%, far eclipsing legends like Buffett's annual return of 22%. So how did he do it? How did a mathematician conquer Wall Street? How did a wartime codebreaker hack the world of finance? And how did Jim Simons become the world's greatest investor? Before he developed sophisticated models that redefined the world of finance, before he laid the foundation for modern-day algorithmic investing, and before he became known as the world's smartest billionaire, Jim Simons was just a little kid in Brooklyn, Massachusetts, fascinated with numbers. Born in 1938 as an only child, Jim was solving complex math problems from as young as 3.
When I was a little boy, I liked math in the sense that I like to, when I was 3 or 4 or something, like to double the numbers 2, 4, 8, 16, 32, etc.
His parents were middle-class American Jews who had high hopes for their son. Jim's father, Matthew, was a film salesman, while his mother, Marcia, was a homemaker. But even though his parents had taken a more realistic route in life, Jim's love for numbers never waned. In fact, by the time he was 8, he already knew exactly what he wanted to be, a mathematician. This is what he told his parents, his friends, and even his doctor. They were supportive of him, but they remained skeptical of his career choice. And if you lived in America during the 50s, you can probably understand why. There was no clear path to financial freedom for Jim if he chose mathematics. Despite these doubts, Simons was dedicated to his studies, always finishing close to the top of his grade, even showing early signs of leadership, getting elected as class president one year, a quality that would play a pivotal role in his later success. In the meantime, Simons was also a voracious reader, going through 4 books every week. The now teenage Jim chose books that were well above his grade level, tackling complex subjects he had no business tackling. So by his sophomore year, Jim transferred to an elite public school called Newton High School, where he graduated in just 3 years. As a result, Simons got accepted into M.I.T. for mathematics, but it was here that things took a turn for Jim. During his first 2 years, he was unable to understand many of the abstract algebra concepts, and as a result, his grades suffered, one time even receiving a D in upper-level calculus. But instead of giving up, Jim confronted the problem head-on.
Don't give up. Persistence has a lot of value, and something that's really worthwhile can take a lot of time to come to fruition, and you ought to have patience if you believe in something to stick with it.
He bought a book on the subject and devoured it until he understood every concept, becoming so skilled that other students often came to him for help. And as a result, Simons graduated from M.I.T. at just the age of 20 and proceeded to enroll at Berkeley. However, Simons felt unsatisfied with the trajectory of his career. The future felt too safe for him, too cut and dry, and he needed a new challenge. So using a $5,000 wedding gift he had received, Jim began looking for ways to grow his money, hoping to escape the mundane world of mathematics. And none seemed better than the stock market. After a bit of research, he drove to a Merrill Lynch office in nearby San Francisco and bought some shares of United Fruit Company. But the value barely budged. Jim quickly grew impatient, so he asked his broker if he had anything more exciting to trade.
He said you should try soybeans.
When his broker told him about the possible returns, Simon's eyes widened. And even though he knew nothing about trading, he bought 2 futures contracts. In a matter of days, the price soared, and he had turned the $5,000 into several $1,000s in profits. However, Simons didn't sell, and days later, the price tumbled as he barely broke even. For most people, this would have been all they needed to give up. But Jim was not most people, and he was now determined to understand the system. Simons would wake up extra early and drive to the stock exchange just to watch the market prices rise and fall. It was a rush. However, with his wife becoming pregnant, it became too much to handle, and Jim was forced to abandon this new obsession. But a seed had been sown, and it was only a matter of time before he'd make his return. After earning his PhD from Berkeley in just 3 years, Simons took a prestigious teaching job at MIT. Jim was living every mathematician's dream, but with the memories of trading in the back of his mind, he remained unsatisfied, so he left. First, to start a PVC business with a couple of friends, helping supply some of the funding.
But at the time, I had made a small investment with my Colombian friend. I had some friends in Colombia, and I urged them to get together and make a business, which they did, and I had 10% of it that I had borrowed from my family.
With the business in good hands, Jim returned to academia, teaching at Harvard and even Cambridge Junior College. But the truth is that by now, he was broke. The debts from his PVC investment were peeking at him from the horizon. So in 1964, Jim left academia to work for the Institute of Defense Analysis, or IDA, a US intelligence group, doubling his income. You can say that it was a bridge between Jim's math background and his future trading, because it was here that he learned how to develop many of the mathematical models that later helped him create one of the world's most successful hedge funds. Jim immediately felt at home at the Institute, and soon enough, he found success cracking codes. But that's an understatement. Upon arrival, Simons developed an ultra-fast code-breaking algorithm used by the CIA to see encrypted messages sent by the Soviets, quickly making him a star within the organization. And within a few years, he was already in line to lead the department. Better yet, as part of his role at the company, he was granted a generous amount of freedom to pursue his own interests. And for Jim, that was trading. So Simons and a few of his colleagues spent their spare time trying to crack the stock market. They developed a stock trading system that they claimed could generate annual returns of at least 50%. And even though their paper had some major flaws, like assuming that they would be able to trade without commissions, they concluded that there was a way to profit from the market's unexpected moves without knowing anything about a company's earnings or growth rates, which is what most traders focused on, a discovery that he would soon use to build his empire. During Jim's time at the IDA, protests against the Vietnam War began to escalate. Students harassed the office he worked at, trashing the building and throwing eggs at employee cars. So Simons, who was opposed to the war, did an interview saying that he was going to start devoting all of his time to his own mathematics research until the war was over.
And I told him that, I'm doing mostly mathematics now, and when the war is over, then I'll do mostly their stuff.
Soon after, he notified his boss about it.
Then I did the only intelligent thing I'd done that day. I told my local boss that I gave that interview, and he said, "What did you say?" And I told him what I said. And then he said, "I got to call Taylor." He called Taylor. That took 10 minutes. I was fired 5 minutes after that.
The 29-year-old was now unemployed, but getting a job wasn't a problem. He was a mathematical superstar, and soon enough, he found himself serving as the chairman of the math department at Stony Brook, where he built a world-class team, while even winning the Oswald Veblen Prize, the highest honor you can win in mathematics. Jim was now positioned in the upper echelons of the world of math. However, Simons longed for more, so in 1978, he decided to transition into a new venture, back to his passion that had refused to die, trading. After raising nearly $4 million from a group of investors, combined with his own money, he launched his first hedge fund called Money Metrics. Despite having very little success trading on the side prior to this, given his background in mathematics and discoveries at the IDA, Simons dreamed of creating a trading system that could identify and profit from patterns in the market seemingly invisible to the naked eye.
After a little bit, I started collecting some data, and I figured there's something to be modeled here. There's something to be modeled here like we used to do in the old IDA days. So I brought in the best modeler in the world, Lenny, a guy named Lenny Baum.
He began by hiring an old friend from the IDA, Leonard Baum, who was the creator of the Baum-Welsh algorithm. The accuracy of Lenny's algorithm was frightening, to say the least. Without knowing anything about baseball, Baum's algorithm could estimate the probabilities of any event happening based on previous patterns, an innovation later used in the world's first effective speech recognition system, and even Google's search engine. Using Baum's help, the two developed a simple mean reversion model to trade currencies, buying them if they moved a certain level below their recent trend line, and selling them if they veered too far above it. They did all of this while also trading on their own instincts. But over time, Lenny began to rely on his own instincts more than the models. And since he was right most of the time, Jim followed suit. So for the next 2 years, they would find success Lenny's way. This wasn't the original plan, but it worked. One day, Baum was convinced that the British pound would go up, so the two rushed to the office and began buying, watching the currency soar. As a result, Simons followed this up by making more predictions on the Japanese yen, West German Deutschmark, and the Swiss franc, and over the next 2 years, his fund grew by tens of millions of dollars. But Jim's excitement would get the better of him. With his confidence at an all-time high, Simons decided to start trading bond futures. But unlike last time, the losses quickly piled up. Simon's phone lit up like a Christmas tree as clients demanded to know why they were losing so much money, and as Jim was growing more anxious, the losses only increased, topping $1 million.
But I could see that this was a very gut-wrenching business. You know, you come in one morning, you think you're a genius, the markets are for you. We were trading currencies and commodities and financial instruments and so on, not stocks, but those kinds of things. And the next morning you come and you feel like a jerk, the market's against you. It was very gut-wrenching.
Moneymetrics was on the brink of collapse, and it was clear that something needed to change. With Moneymetrics on the verge of implosion, Simons knew that he could no longer rely on his own intuition, and he was determined to build a more sophisticated way to trade that was fully automated, essentially allowing him to make money when he sleeps. Using heaps of historical data, he soon built another model called Piggy Basket, which looked for correlations between commodities. In simpler terms, the model would analyze questions like if a currency went down 3 days in a row, what were the odds of it going down a fourth day? Then churn out recommendations on what and how much to buy.
So we built a business 100% based on building computer models, starting in those areas that I mentioned, currencies, financial instruments, gradually moving to stocks, and finally to anything that moved.
Within a few months, this new model began delivering big profits for Simons, using $1 million. So much so that Simons gave the model even more money to manage, delivering even larger gains. As a result, he renamed his hedge fund to Renaissance Technologies in 1982, reflecting this more technology-based approach. But soon, the model began to falter. In one instance, the model developed an appetite for potatoes, using 2/3 of its cash to corner the market, resulting in regulators calling him up and forcing him to close his position, costing Simons millions of dollars. Desperate for a solution, Simons brought on another prized mathematician named James Axe to help refine his algorithms. And in 1988, the two opened up a new fund called Medallion to test these new models. But very quickly, the fund stumbled once again, and by early 1989, they were already down a stunning 30%. Clients began pulling their money from the firm, and with tensions between Simons and Axe rising, Axe left. Jim's strategy of automated trading was looking hopeless. With Medallion struggling mightily, something needed to change, fast, but Simons knew exactly what to do.
My idea of leadership of an organization is to hire the very best people you possibly can. And I have a good taste in people. And then let them carry the ball.
Jim brought in another academic named Elwin Berlekamp to help turn around his struggling fund. Berlekamp had a very different approach to trading. He wanted Medallion's models to resemble a casino, not trying to win every trade, but realizing if they made a lot of trades, they only needed to be right 51% of the time to make big money. So he shifted the firm to a short-term trading strategy, often holding positions for 2 days instead of 2 weeks. A lower risk strategy in his eyes, because if you make more trades, the magnitude of each trade becomes less important. Soon the returns began to stack up, and in 1990, the fund returned a stunning 55%, focusing on commodity, currency, and bond markets, making profits nearly every day. This was it. This was the fully automated trading system he dreamt of when he quit his math career to dive into the world of trading 2 decades ago. Simons was now convinced that he was on the verge of remarkable success. But with more competition than ever, Jim knew that he would need to find even more ways to make money. So he doubled down on what was working. Simons hired another former colleague and mathematician named Henry Laufer from Stony Brook. Laufer developed an even faster algorithm that would trade throughout the day while also learning on its own, an early form of machine learning. And soon, the fund began trading even more frequently, watching their orders skyrocket to 5 times a day before eventually increasing to 16 times a day. As a result, Medallion continued its ascent, returning 33% in 1992 and 39% in 1993, helping their assets balloon to $280 million. It was an extraordinary result, considering this was after Simon's unheard of fees of 5% of all assets and 20% of all gains, which he has since raised to 44%. But Simons wanted more. He finally saw his chance to become a billionaire, and the only way he could do that was to expand his fund into equity trading. Despite Medallion's recent success trading commodities, Simons still struggled to make money trading stocks. Many of their equity models picked trades that seemed attractive, but they were too unrealistic, and those trades couldn't actually be completed, which jeopardized the entire portfolio. Drawing on his previous experience, Simons hired 2 top scientists from IBM, Peter Brown and Robert Mercer, who had developed key speech recognition technology, later used by Alexa, Siri, and Google Translate. The duo spent 2 years revamping the company's equity models, combining all of the company's signals into a single algorithm which placed more realistic trades, something the rest of the industry didn't have. Jim was now light years ahead of anyone else in the field, with a secret weapon that would make him billions. Combined with Laufer's existing trading strategies, Medallion continued to soar, finishing the 90s by returning over 20% every single year after fees, helping their assets skyrocket to $1.5 billion. It was unheard of and almost unbelievable if there wasn't proof. What was particularly impressive was the consistency of these returns. And throughout the 90s, Medallion had a Sharpe ratio of 2, double the S&P 500, meaning that their returns came with very low risk and volatility. But that was all about to change. Following a stellar decade throughout the 90s, Medallion surged into the turn of the century, returning 10.5% in January, their best 1-month return in years. And by early March, the fund was sitting on over $700 million in profits, as enthusiasm over tech stocks had a record high. It seemed like nothing could stop Simons, and then disaster struck. After peaking on March 10th, the market began to show some weakness, and 1 month later, the Nasdaq would be down 25%, on its way to a 78% drop. Meanwhile, Medallion faced inexplicable losses. On a single day in March, the fund lost nearly $90 million, followed by $80 million the very next day. Massive losses, considering Medallion had never lost more than $5 million in a day. Their machine seemed out of control. Panic spread among the employees, and within days, the fund's losses approached nearly $300 million. However, Simons remained calm, and after nights of research, the company spotted a fault in their model, which was trained to buy more shares of stocks that were rising. And since the Nasdaq had been racing higher, it was still buying shares, even though the market started crashing. Following a few tweaks to their trading signals, Medallion roared higher, and by the end of the year, the fund was up a stunning 99%, helping set the stage for a new era of trading. Coming out of the dot-com bubble, information was starting to become much more accessible, and seeing the opportunity to improve their algorithms even more, Medallion turned into a data sponge, collecting terabytes of data annually from any source they could get their hands on. With all of this data, they soon rolled out a new style of trading known as high-frequency trading, allowing them to make between 150 and 300,000 trades per day. Meanwhile, their success attracted some unbelievable opportunities, and Deutsche and Barclays Bank approached the fund with a new product called basket options, which allowed Medallion to make all of their trades inside of a single options contract. It was a crafty way for the fund to supercharge their returns using leverage, since they were allowed to trade $12.50 of assets for every dollar of cash. So even though the fund managed over $5 billion, it controlled more than $60 billion of investment positions. Better yet, this leverage was essentially risk-free, since the banks technically owned the underlying securities. As a result, over the next 2 years, the fund returned 33% and 26%, while the S&P 500 generated a horrific -12% and -22%. Soon, the fund began exploring even more ways to make money, launching their algorithms internationally, a genius strategy that smoothed out the fund's returns even more, since these markets didn't move in lockstep with the US, helping Medallion's Sharpe ratio soar to nearly 6, meaning that there was nearly no risk of the fund losing money during the year. Simon's team seemed to have hit the investing jackpot, generating enormous returns with very little risk and volatility compared to the overall market. So in 2005, Simons opened up a new fund called Reef, which he hoped would resemble Medallion's returns while only charging a 1% management fee. Within 1 year, Reef was already outperforming the market, resulting in investors piling $14 billion into this new fund. And by 2007, Simons could hardly keep investors away, as their assets soared to $35 billion, making Reef one of the largest hedge funds in the world. Simons had officially built the financial empire that he dreamt of for decades. But trouble was around the corner, yet another battle to fight, one that was about to end Simons' career. By July of 2007, Medallion was already up 50% for the year. However, Reef was sitting at a minor loss, but for Simons and his team, this didn't seem like a big deal. Then, on August 6th of 2007, everything unraveled. At the opening bell, selling overtook the market as word emerged that a smaller quant fund was in trouble, while a similar division of Goldman Sachs was also suffering. And given that many quant funds were piled into the same trades, Medallion and Reef were getting crushed in an event now known as the Quantquake. Tuesday was even worse, and on Wednesday, Simon's team determined that if they suffered too many more losses, they could be margin called. Needing to build their cash position, Simons ordered the firm to begin selling. The scientists were alarmed. They wanted to ride it out. They trusted their models. But Jim had already made up his mind. It was time to sell. But as they did that, the market fell further, causing even more losses. In just 1 week, Medallion was already down a stunning 20%, while Reef was down another 10%. The situation was looking bleak, and the banks that had provided Simons with their basket options seemed to be on the verge of pulling the plug. If they did that, it would crush Jim's empire. Clearly, selling was not the answer. Waiting it out was, because the following week, something unusual happened. Both Medallion and Reef were making money again, almost like nothing ever happened. Before long, Medallion regained its footing, helping them return a whopping 86% in 2007. And in 2008, as worries about subprime mortgages spread throughout the market, Medallion thrived, soaring 82% that year, netting Simons over $2 billion in personal profits. But the firm had left money on the table following Jim's decision to sell, and more importantly, Reef was still underperforming. So even though Jim insisted that he wouldn't have done anything differently given a second chance, the writing on the wall was clear. It was time to step down. So in 2010, Jim Simons retired as the CEO of Renaissance. Their leader, the one who built this financial juggernaut, was now gone, and many wondered if Renaissance would ever be the same. Following Simon's retirement, Medallion has continued to soar, returning over 29% every single year, led by Peter Brown and Robert Mercer, who eventually resigned in 2017 over his political beliefs. The firm has since expanded to 3 funds for outside investors, and today their total assets have reached $60 billion, making Renaissance one of the largest hedge funds in the world that sometimes represents as much as 5% of the daily stock market trading volume. As for Simons, given his ownership in the firm, he has been able to earn billions more dollars for himself, and his net worth now sits at a stunning $28 billion, making him the 48th richest person in the world and one of the wealthiest men in finance. With all of this wealth, Simons has given billions to philanthropic causes, co-founding the Simons Foundation in 1994, while also donating millions to Berkeley and M.I.T. From a boy with a deep fascination for numbers, to a math professor who won the highest prize in his field, to a codebreaker who helped topple the Soviet Union, to a hedge fund boss who cracked the stock market and amassed billions of dollars in profit, Jim Simons' legacy is undeniable. It is untouchable. He is, without a doubt, the greatest investor the world has ever seen.